Imagine you're running a business. You check your internal books, and you think you have 100 grand in the bank. Then a text from your bank pops up, and your balance is effectively zero. That terrifying gap is why modern accounting exists. As trade and commerce scaled up, physically handing over briefcases of cash for every single transaction became impossible, not to mention incredibly risky. Modern banks operate as a sophisticated engine for commerce. They process term loans, collect dividend warrants, manage cross-border remittances, and issue letters of credit. With that massive volume of complex financial activity moving in and out every single day, keeping track of your cash purely by memory is a guaranteed path to ruin. You have to maintain a strict dual record system. Looking at this antique ledger, we see the first of two parallel tracking realities: the cash book. This is the internal record maintained entirely by the business itself. On the other side, the bank provides their own record of your account back to you. Traditionally, this was a physical passbook sent in to be updated by the bank, though today you're usually looking at a net banking statement on your phone. Because these two books are tracking the exact same money, they follow the mirror rule. Assuming both sides are perfectly accurate, their final balances must equal each other, but their accounting nature will be completely mathematically opposite. This happens because the business treats the bank as a debtor. To the business, the money deposited is a debit, an asset, but the bank views that deposited money as a liability, a credit that it owes back to the business. The problem is, when you reach the end of the month and those mirrored balances don't actually match, you are left with a massive vulnerability. It creates a blind spot where financial misstatements and corporate fraud can easily hide. To close that blind spot, accountants use a systematic investigative tool called a bank reconciliation statement. Its entire job is to track down and eliminate the discrepancies between the two ledgers. The first culprit it usually catches is timing. For example, if a business writes and issues a check, they immediately deduct that money in their own cash book. But the bank won't recognize the transaction until that physical piece of paper actually arrives and is presented for payment days later. The reverse is also true. You might deposit a client's check and update your internal cash book instantly. However, the bank won't actually credit your account until those funds officially clear. The second major culprit involves unilateral bank transactions. These are financial moves the bank makes entirely on its own, without calling you first for permission. This includes levying sudden bank charges, crediting interest to a savings account, accepting a direct deposit, or applying a penalty fee when a bill discounted with the bank is dishonored. You only find out about these moves when you finally check the passbook. Because time delays and automated background actions are built into the mechanics of commerce, discovering a mismatched balance at the end of the month is an inevitable reality of doing business, not some rare anomaly.
Then we get to the third culprit: human error. Mistakes can happen anywhere, caused by either the company's internal accounting team or by the bank's own professional staff. Someone might record an incorrect amount, accidentally post a single entry twice, place a transaction on the wrong side of the ledger, or simply mess up the math by overcasting or undercasting the total balance. So how do we fix all this? The core mechanical solution is the plus and minus method. You take a starting balance, let's say the debit balance from your cash book, and you systematically add or subtract specific discrepancy items until your math perfectly hits the final passbook balance. If the exact causes of the discrepancy are unknown, you have to use the brute force approach. You manually compare the books line by line, ticking off debit entries in the cash book against credit entries in the passbook, until the leftover, unticked culprits are isolated. By sorting every single discrepancy into either a timing delay, a unilateral transaction, or a flat-out error, the reconciliation statement transforms a chaotic mess of financial data back into a verifiable truth. Here is where many people make a critical mistake. A standard plus and minus reconciliation statement is ultimately just a piece of scratchpad math. It explains the difference, but it doesn't actually correct the flawed internal records inside the business. To truly fix the problem, you have to follow the adjusted cash book rule. Permanent issues, like human errors in your ledger or those unilateral bank charges you didn't know about, must be permanently corrected inside your company's actual cash book first.
Once those permanent fixes are logged, the only things left should be pure temporary timing differences, like checks still floating in transit. Those temporary items are all that belong in your final reconciliation statement. For students and accountants alike, the adjusted cash book is a mandatory requirement when conducting reconciliation at the end of the financial year. This two-step process ensures that the internal corporate records are legally and permanently accurate, rather than just temporarily explained away on a separate sheet of paper. Ultimately, the bank reconciliation statement exists to find the true, verified bank position by incorporating all uncleared funds and correcting all hidden errors. This regular discipline prevents bank accountants or internal staff from secretly embezzling funds. Because the numbers must align across two different institutions, any attempt to fabricate a ledger entry is immediately exposed. By consistently bridging this financial divide, the reconciliation statement protects stakeholders, secures the company's true reality, and ensures every dollar is exactly where it's supposed to be. But cash is only one type of asset. Once we step away from the bank and head into the warehouse, how do businesses track millions of dollars in physical goods? We'll tackle that next in Inventory Valuation.